Hello and welcome to FT Markets here in New York. Well, it may be 2014, but for a few moments this morning, it almost felt like we've been transported back in time to the go-go boom days of IPOs from the late 90s. Yes, we're talking about Alibaba, the biggest IPO of all time, a huge run-up in the stock price after it listed at $68 a share this morning. And joining me now to discuss what this all means is Nicole Bullock, who's been covering Alibaba for us here. And Nicole, is Alibaba the biggest of all time?
Well, it depends on how you kind of slice and dice the data. So basically, the offering raised for Alibaba and selling shareholders about $22 billion, which makes it the third largest in terms of the size of the actual offering. If they exercise an over-allotment option, that'll take the size up to $25 billion, which will give it the bragging rights of biggest ever. But in terms of market cap, it already is the biggest ever at pricing.
Well, when we look at Alibaba, I mean, it was listed at $68 a share. It debuted at 92.70 cents. It ran up towards $100. What's the outlook? I mean, normally with these IPOs, blockbuster IPOs, it does tend to be a selling. Insiders start to sell. People who are involved in that first day pop look to sell, and often the prices drop quite a bit. But what's your perception here? What are people sort of saying when they look at Alibaba's prospects over the next month or so?
Well, certainly the downside of having such a big rise is that it raises the question of profit taking, even for investors who bought at the IPO, because you would already be able to pick up a third.
Substantial gains already.
Exactly. So that's definitely a question. Heading into day one trading, what we were hearing is that many people thought the $68 was actually pretty reasonable and that the company was worth more than that. What we've been told is that profit taking becomes an issue around $100. So that's one area to look for. The other factor is that, again, we've been told all along by our sources that the company was eager to sort of stack the shareholder base with long-term investors. And in fact, this was something that Mr. Ma actually, the founder, Jack Ma, the founder of Alibaba, actually mentioned in a letter to investors that was published in one of its regulatory filings, specifically mentioned that he was seeking long-term investors. So there is a sense that they're trying to mitigate that factor. Now, obviously, that's once you list shares, that becomes a bit beyond your control. As well, there are about 128 million shares that are not subject to a lockup. So that's a bit of an unknown factor as well in terms of whether or not those people will sell. So it's certainly the flip side of the coin of having such a big rise is whether or not you have managed to get into your shareholder base investors who are in it for the long haul and really see very much long-term value in your company.
Right, so let's look at another statistic which I thought was quite interesting. In terms of IPOs more than 10 billion in size, it had the biggest opening pop we've seen, surpassing Visa's. So has Alibaba left money on the table here?
Well, one thing that companies and their advisors always try to do with initial public offerings is really strike that balance between ensuring that they haven't pushed the outer limits of the price too far, that they have a bad trading experience, and as you said, leaving some money on the table. What we've been told all along through the whole process with the marketing tour of Alibaba is that the company was very mindful of making sure that the shares traded well, even if that meant potentially leaving a little bit of money on the table. As you pointed out, it's a gigantic deal. It's a very high-profile deal. Nobody wanted to, have a screw-up on the first day where, it drops like a rock or something like that. Right. And of course, the experience in 2012 with Facebook, still really lingers as a cautionary tale for a lot of companies going public, especially in big, high-profile deals. So there was an instance where a lot of things went wrong for Facebook. They aggressively raised the price, they raised the size of the issue, and then there was a technological glitch on NASDAQ where they listed. So, you had a big share slump after that. And that's really lingered for a lot of people, and nobody wants to repeat that experience.
And finally, let's look at the landscape now for the rest of the market, these companies that are in the pipeline of IPOs and looking to come. Has does Alibaba sort of make it difficult now for companies to try and come in its slipstream?
Well, there's a couple of factors at play. The first thing to note is that even without Alibaba, we're in a banner year for IPOs. Even before you include that 22 or 25 billion, whatever it ends up being, we were running at the fastest pace in terms of number and dollar amount of IPOs in the US since 2000. So already it's been a great year. There was definitely a sense when Alibaba kind of got rolling in the final aspects of its IPO that some companies kind of wanted to stay out of its way. They didn't want to compete for bankers' and investors' attention. So there is some sense that we might see a bit of like a spate of activity come once the dust clears on Alibaba. And since it's gone so well, usually when people are making money, they feel good about spending more money. So
the market is at a new record
exactly.
High this week.
Some people are talking about a halo effect from Alibaba being actually positive for IPOs to come. In terms of whether investors are saturated at this point, having bought all these Alibaba shares, the general feeling is that there's enough money on the sidelines, on the buy side, that it can accommodate all of this.
Great, Nicole. Well, thanks so much
Thank you
for helping explain Alibaba's blockbuster debut.